Hi everyone. So today is our third lesson for strategic financial management, and let's see what we will be covering in this particular session. So moving on, I will be just going through kind of like a lesson specification. However, I'm not very sure whether we'll be able to cover all these today. However, I will try my best to kind of follow these and move on and kind of teach y'all all these sections in the coming weeks as well. So this section will basically talk about importance of the financial environment and even the markets, and especially it would be related to financial environment. And initially we'll also be talking about the financial management and related concepts as an introduction. Thereafter, we'll be moving towards more important concepts. So as you can see, there are the topics that we might probably be covering. So initially, I will be covering the accounting concepts and the theory. So first, these are basic things we actually know. So let me just kind of skim through this, to refresh your memory. So as you know, the accounting conventions are like basically a set of practices that are generally accepted to be followed by accountants. So there are main four conventions that are kind of followed or used as accounting conventions, which are objectivity, consistency, materiality, as well as prudence. So moving on, I will just be giving you like kind of like an introduction of financial management and different levels of financial management, and try and help you to go through some of the financial management concepts. So first, moving on with what financial management is. Before talking about anything, I think it's very important for us to understand what financial management is. So what is financial management? It is basically, it could be defined basically as the management of finance of a business or even organization, which is done in order to achieve their financial objective. So this can be identified as like planning, organizing, even directing and controlling the financial activities of an organization, and trying to achieve these financial objectives of the particular business or the organization. So moving on, we'll now just try and understand the levels of financial management. So one is from an individual point of view. So we'll try to understand from an individual point of view. An individual generally engage in a process of financial management by tailoring expenses according to the financial resources and by investing any surplus. So companies review their financial decisions which benefit them in a long run and helps them to achieve their financial objective. So generally, when it comes to finances, if we talk about what we spoke in the first two sessions, we were talking about how to manage the resources and mainly the financial resources. So basically here, it is kind of like the process in which these resources are kind of managed and how the surpluses are invested. So this is kind of like going through the, trying to go through this particular process and try and understand how the financial objectives are met. So from a corporation's point of view, now organizations are generally involved in managing their finance. So basically when it comes to corporations as well, what they do is they try to focus on their overall objective and try and see to try and address the stakeholders objective rather than an individual objective. So this would basically be like a process which is kind of mainly involved in financial planning or control. So the difference is, when it's individual point of view, it's just the point of view of one person. But when it comes to stakeholders, it would be different people. Like, let's say it could be shareholders. Also, it could be other sectors related to, like, companies, the government, or even the community. All these sectors are called as stakeholders. So therefore, it's vital that an organization looks into all the stakeholders in order to ensure that their financial objectives are kind of met. So that is about the levels of financial management. Now we'll be kind of going through the key elements in a process of a financial management. So as I explained to you what financial management is, I talked about the planning, control, and decision making. So these are the main key elements under the financial management, as you can see. So first is financial planning. So what is financial planning? This is basically like the managers generally need to ensure that they have sufficient funds for their short-term, medium, or even the long-term requirement. So for that, the managers need to plan it out. So that is what we call as planning financial. So financial control. Now, what is financial control? This is something that I spoke about last week also, controlling the resources. So here what happens is managers need to ensure the company's objectives are being met by trying to control their resources and kind of checking whether that is properly met. Thereafter, financial decision making is being talked upon. So decision making is all the decisions that a company needs to do regarding investment, financing, and dividends are basically called that financial decision making. Now, talking more, we'll be talking about key decisions in financial management. First, we'll be talking about financial decisions. So what is financial decision? These are related to the sources of finance of a company, where the decisions are kind of made accordingly. And investment decisions are when, alternative that the organization need to move on towards to increase the shareholders' return while minimizing the risk. Now, dividend decisions are basically the decision regarding dividends which is paid to shareholders. So, which this would result due to the shareholding of a company. So moving on, we were obviously talking about managing finance, where mainly we were talking about gathering, allocating, and controlling finance. So this is basically related to resources. Actually, we were talking about something related to managing, allocating, and controlling resources during the past 2 weeks as well, where we were talking about resources. Here we will generally say how we need to generate, allocate, and control the finance or the monetary resources. So the objectives. So what objectives? What are the objectives of financial management? So basically the requirement of regular and adequate working capital to run the operations should be met by an organization. Obviously, if the working capital is not kind of managed, then obviously the day-to-day operations will not happen properly. So it is very important that the company need to control their working capital. Thereafter, to pay adequate return to the shareholders. Obviously, for a company to kind of maintain, obviously, they need to pay back their owners, who are the shareholders. So adequate return need to be paid back to the shareholders, another objective for a company. and also optimum utilization of funds by allocating them into the best possible way in order to cover up its costs. So utilizing the funds properly is it's like one of the main important things to do. So we were talking about resource utilization as well. So this needs to be done in order to get more profits, so that the working capital can be managed and the shareholders can be paid as well. Secured investments, obviously when a company needs to grow, company cannot stay in the same position. For it to grow, it needs to do investments, and proper investment decisions need to be taken. And a balanced capital structure between debt and equity, which sounds fair. So one thing that we understood is that there are debts as well as equity. And when it comes to debt, the organization need to repay, while the equity, the organization does not need to repay. However, when there is more debt, there'll be higher gearing for an organization, which could be an issue sometimes while taking even loans later on to manage the organizational resource. Therefore, an organization always need to kind of manage, have a balanced debt and equity ratio in order to ensure that the management of the organization happens well. And then lastly, it will be to create the wealth for a business organization as well. Now we will move towards the sources of finance. So first, now when it comes to financing, now there are various sources for business to provide different benefits and costs. So it's very important for an organization to evaluate these specific requirements and try and understand what are the sources that the organization has in order to select the best suited need for the business as well. So these are basically the sources of finance. So basically when it comes to business, they raise funds for business startups, for expansions, or for development. So initially shareholders need to kind of move on with when it comes to startups, obviously there should be some kind of investment. And where there is expansion, obviously there is more funds that are needed. Then the organization need to find the funds. And even if there is some kind of development for the same thing, the organization need to kind of raise more funds. Also, these decisions can be crucial for the survival of an organization. So it's very important for any business to kind of understand the various sources of finance and the appropriateness of those financing needs in relation to their needs as well. So now let's look at the criteria for choosing between the sources of finance. So when an organization is trying to figure out which source of finance is most suited for that particular need, what they need to look at it would be the cost of the source of finance, and then the duration that they need to move on towards, and then the term structure of the interest rates at that time, and the gearing of the organization. Because if it's a highly geared organization, obviously funding using debt would be not something that a decision that an organization need to move towards. But if it's a low gearing company, obviously they can move towards debt, but in a balanced way, to ensure that the gearing doesn't be high as well. So that needs to be managed. And then it would also depend on accessibility as well. Now, talking about sources of finance, all these sources kind of end up being in the financial statements of an organization. So now let's see how this happens. So company's house of data. So a company's house is a registry of corporate information. So it would carry out basic checks to make sure that the documents have been fully completed and signed. but doesn't have it doesn't actually have a statutory power or capability to verify the accuracy of the information that the corporate entity send. However, it accepts all information which entitled to deliver to them in good faith and places it on like a public kind of record. So the fact that the organization had to be placed in the public record should not be taken in order to indicate the company's house has verified or validated in certain ways. So now let's look at the main functions of companies' houses. One is to incorporate and dissolve limited companies. Thereafter, to examine and store company information delivered under the Company Act and related legislation. Thereafter, to make this information available to the public as well. Now, moving on, we are just going to talk about the financial statements and what is included in it, because obviously the sources of finances will obviously be represented in this financial statement, as I told before. So profit and loss account. So basically what is included in it? It would have all the income statements which shows the revenues and the expenses of a particular accounting period, obviously. And then the revenue earned from that accounting period is matched against the expenses incurred by the business for that period. And so here the matching principle is kind of used. So basically in a profit and loss account, the sources of finances related to that particular financial year, which is basically revenues and expenses, will be included in the profit and loss account. So now let's move on to try and understanding what the purpose of a profit and loss account is. So in order to determine whether the organization business has made a profit or a loss as a result of their trading operation, the profits and loss statements are prepared. Also, this profit and loss account will kind of provide a summary of like various expenses and revenues related to that period. So it's very useful tool in order to decision making, to decide what revenues the organization has per year and what expenses that the organization need to incur in order to get that particular revenue. So moving on, we'll just try and understand different types of expenses related to it, like operating expenses. Generally, what are operating expenses? These are like generally the expenses that is related to operating an organization, like the admin expense, sales and distribution, and the financial or the other expenses as well. So moving on, cash and accruals accounting. So we are gonna, as we are talking about different concepts of finance, one of the main things that we use in accounting is the cash and accruals accounting. So cash basis accounting involves recording revenue which is actually received and which are expenses that are paid. So that is the cash basis. Now, what is accruals basis? This basically involves recognizing the revenue when it's earned and recognizing expenses when it is incurred. So it does not necessarily mean that the cash is received or paid, but when that particular transaction happens, that will be included. Therefore, according to the accruals basis, the revenues which are not received, revenue received but not yet earned yet, the expenses which are incurred not yet paid, and the expenses paid but not yet incurred are all included in the accounts in order to ensure that all the term information related to that particular financial year is included in the accounting. So thereafter, we'll be talking about balance day adjustment. What are these? At the end of like a accounting period, the financial reports will be kind of prepared. So the last day at the accounting period is kind of considered as balance day, where all these accounting balances are being kind of adjusted. So when using the accruals basis, often account some adjustment to revenue expenses will need to be made at balance date, and these adjustments are known as balance day adjustments. And these adjustments are necessarily to reflect the true value of the revenue and expense items and to a particular accounting period. So these balance day adjustment will include prepaid expenses, prepaid revenues, accrued expenses, as well as accrued revenue. So when it comes to prepaid expenses, what happens is the prepaid expenses are expenses that have been paid in advance. So as you can see, like something that is paid in advance will kind of be included in an organization report. And there is actually an example where the wages have been paid for 15,000 on a particular day, and it is related to it is said that 3,000 GBP is actually related to next period. So that means the expenses are kind of prepaid and it has to be included in the next accounting year. So so prepaid expense generally, as it is something which it comes from the next accounting year, it is considered a current asset. And accrued expense, if there is something that there is still a owing balance or something where say in this example there is advertising expenses 23,000 and outstanding amount of 1,000 is owed as at that period. So this 1,000 is known as a accrued expense, and it is basically considered a current liability because it has to be included in the present recorded financial statements. Now prepaid revenue, same thing. So revenue, if it's prepaid, obviously it is a current liability. And as you can see, you know, there is this explanation where they talk about the commission revenue is 52,000 GBP, which is received by this particular time. And so 4,000 of it is not relevant to the accounting period. So this amount is known as the prepaid revenue. So we have actually received a revenue beforehand. That means it's a current liability because we need to include that in the next financial year. Therefore, it's a current liability to us. Now, accrued revenue is like the revenue earned in the relevant accounting period, but not yet received. That means this is something which would be an asset for us. And accrued revenue obviously will be a current asset. So when it comes to balance day entries, there are a few more things that will be included, such as depreciation, which is an expense that relates to fixed assets, as well as the value of fixed assets over time will diminish, and this decreases in value present to the business, and it will also be allocated over useful life of asset and will accumulate each year. So this accumulate depreciation, how do we use it? The useful, what we would do is useful life of an asset will be used here or will be used to the business, and the scrap value or what the value that the organization will get after this year's full period of life will be reduced, and the original cost of asset will also be included in the accounts. And depreciation is something where the original cost is divided among, you know, the useful life. If it's 10 years, it will be divided among 10 years. If it's 5 years, it will be divided among 5 years. So what is doubtful debt? This is the debt where the business have percentage of debtors who have we need to receive, which is supposed to be received. However, if they are not going to pay us back, we will include doubtful debts. And so the company, what they do is they keep allowance for doubtful debts just in case the debtors don't pay them back. So bad debts is when they actually don't pay. And generally closing stock is something that it's basically a balance day payment, where a value attached to kind of any stock will be calculated and used as closing stock. So basically this actually happens with the current assets, like kind of like the stock of stock related to the materials as such. And now we'll be moving on to the balance sheet. So if you look at the balance sheet, this will actually have like the assets, liabilities, as well as owner's equity of an organization. It generally provides kind of like a snapshot of the organization. So assets, basically the value owned by the business, and liabilities with the financial obligation of the business, and current assets. So the assets can be fixed assets, which is like the assets which are tangible goods, which need to be capitalized and depreciate over the time. And current assets will be things like cash, as well as the other assets, which can be converted to cash very quickly or in a short period of time. And then there'll be liabilities, where which will include non-current liabilities as well as current liabilities. Current liabilities are kind of like the short-term kind of debts which we need to pay in like a near future. And current liability, so when it comes to long-term debt, it would be something like the mortgages, the leases, and the warrants that an organization needs to pay. Thereafter, we'll be talking about the owner's equity. So owner's equity is basically the shareholders' capital, which will be included, as well as the reserves. So basically, when it comes to consolidated balance sheet, this is like the consolidated balance sheet would generally be for an organization, a set of organizations actually, which has few companies, and all these costs and kind of like assets will be consolidated into one particular accounting section. And now moving on, we'll be talking about cash flow statement. So what is cash flow statement? This is basically a statement which talks about the movement of the money of a business. So when it comes to the movement of the money, we need to understand that the measurement of cash flow can be used for calculating the other parameters of the company, such as calculating the cash movement, which would have like the rate of return of value of time of cash flow, which is in and out of the project, and also like the IRR and NPV and things as such. Okay, so another thing is to determine the problems with the business's liquidity, where we will kind of use the profitability to kind of identify whether whether a certain thing activity is kind of liquid, or whether the company will have a shortage of cash because of this liquidity issues. And there will also be like alternative measures of business profit when it's believed, where this will obviously not consider the accruals concept. So therefore, the balance sheet and the income statement considers accruals concept. So therefore, all these accruals, payments and prepaid payments are all included in those. However, when it comes to cash flows, what happens is the cash that is there in the organization, what is received and what is paid, will be included to try and understand the working capital of the organization, to see whether the organization can manage with the current kind of assets that they have. This is more of like very useful in operations of an organization. So this will be used to evaluate the quality of the income generated, and the net income is kind of checked whether it is non-cash items or so. If it's non-cash items, obviously it would be of low quality, and if it's cashable, a short-term item which can be cashed very quickly, here it is considered to be good. So also one thing is they'll be considering about the risk with the final product. So matching the cash requirement and evaluating the default risk and reinvestment requirement. For all these things, cash flow statement is very important, and it will kind of be used to calculate different parameters of the organization, and like example, to disclose cash movement over the period of time, and based on it different decisions will be made. Like even for investment decision, what is considered is not whatever is in the accounts related to income statement or balance sheet. What will be considered would be the cash flow statement, because in order to invest on something, the organization need to have proper cash flow to invest. They don't have the cash flow, obviously, then there'll be obvious issues where they won't be able to kind of invest on that particular activity, even though there is profit involved in the income statements, because it is basically an accounting kind of perspective. Cash flow is more operational, and it kind of includes all that is related to happening day to day. And when it comes to cash flow statements, so moving on further, we can see that the movement of the money in and out of business, project, or even financial product is generally considered as cash flow, and generally it is measured during a specified limited time period. And measurement of the cash flow can be used for calculating general different requirements or parameters, actually, to kind of identify the value of the situation. So cash flow can be used for general, a lot of things, like parameters such as disclosing the cash movement over the period and things as such. So now we're talking about cash flow. There are three main sections that we need to talk about when it comes to cash flow. There are three. The first section with the cash flows coming from operating activities. Thereafter, the cash flows coming from investing activity. And then lastly, we'll be talking about the cash flows from the financing activity. So when it comes to cash flow statement, these are the three main things that will be included in a cash flow statement. Because now, as you can see, now when it comes to operating activities, what is it? It's one of the most important cash flows of an organization, because it would kind of include how the cash comes into an organization and how the cash will be going out of the organization. What is the amount of cash that is in hand, which is very important, because in order to do any type of operation, you need to have cash in hand, right? So to calculate this operating activities, there are two methods that I use. One is the direct method, where operating cash flow such as uses of cash will be used. Then there is also indirect method, where the reports operating cash by adjusting accrual income to cash flows will be used. So one method is directly just kind of calculating how much cash do we have, how much cash is in hand. That is the direct method. The indirect method is obviously you taking the like the amount that is included in the profit and loss account. Thereafter, you adjust all these adjustments, the prepaid and the accruals. You kind of adjust and try and see how much cash flows are included. So obviously, by doing that, what happens is you look at the accounts and you calculate back, and see whether you actually have the cash that is kind of included in here. So that is like more of a controlling kind of method of trying to get the operating cash flow, I should say. Then cash flows will also be talking about investing activities. So cash flows, inflows which come from investing activities, such as, let's say, you sell a fixed item or you do a particular investment on some kind of machinery, or like, you know, kind of like a process, business process, or even a company or an intangible asset. This the cash flow inflow from investing will be included here. Cash outflow from investing activities are like buying fixed asset or the investment or kind of like intangible asset. So just to kind of like clarify, when it comes to cash inflows, it is the inflows, the cash that comes into the organization by selling fixed assets or selling even a branch or something of that sort. And cash outflow is the cash that we pay back to buy a fixed asset or investment which will give us profit back. So that is how the investing activities of cash flow will be determined. And now let's see how the cash flows of financing activities are kind of included. So moving on, we have the cash inflows from financial activities, which arise from issuing debts, equity and securities and things of that sort. So financing activities will involve things such as securities, because those are like financing section, and outflows will be from paying dividends. So here, debt purchasing, treasury stock, all these are financing activities. So what we need to understand is, when it comes to financing, here we always look at the company's perspective. So when it comes to inflows, it is an inflow of companies, inflow from the shareholders or the debt holders. So when you issue a debt, you get the money. When you issue any type of equity securities, you get money. So when we get the money, we call it as cash inflow. So those are cash inflows for the organization, and cash outflows are when you pay an interest or paying the dividend. So when it comes to financing activity, anything that is related to finances, if we are supposed to pay, then that is considered as cash outflow. And if we are supposed to receive, it's considered as cash inflow. So there are also non-cash activities which involve investing and financing, such as issuing the stock to retire long-term debt, issue stock to debt in exchange for fixed assets. So has no direct effect on cash flows, but those kind of activities could also happen. So as I told, cash flow direct method, I said the cash flow source of cash and certain income statement items will be included here. And that is how the cash flow is determined under the cash flow statement. So as you know, we were talking mainly about different sources of finances of an organization. And we try to understand the sources actually based, and also try to understand different concepts, which I believe is included under one of these sections in your learning outcomes, either 1 or 2, where we talk about sources of finances, as well as trying to understand different accounting concepts to understand what finance is. And we try to identify this using the company accounts, specifically the accounts. So now moving on, we are going towards a certain section, which is also related to the source of finance. Actually, this is more towards controlling and managing. the organization, actually, I should say. So this would actually include a section called Balance Scorecard, BSC. This the thing is, this is a particular management tool that is used. So we could have even included it into a certain section where we talk about stakeholders maybe and things as such. However, I thought right after talking about the financial sources, it's also would be nice to kind of talk about the strategy, because it's a management, performance management tool, that we need to talk a little, away from finances and trying to understand how the management side of an organization kind of works as well, because it's not just financing. Even though we talk about financial, it's not basically financial management. It could also include managing the performance of an organization and the cost of an organization. All that is included here. Now we'll be talking about, as you can see, the balance scorecard. So hold on. Sorry about that. So balance scorecard, or the BSC, is basically like a strategy performance management tool that is kind of used by an organization. So this is basically like a semi-structured kind of report, which is basically supported by design methods and automation tools. So it can be used by managers to kind of keep track of the execution of activities by the staff within their control and try to monitor the consequences arising from this action. So basically, this is kind of like a control tool, actually, but this is not like, a report. This is more towards, it's kind of like a creative side of it, where managers try to track the execution of the activities and try to monitor and control what are the consequences that could happen due to this particular activities of the organization, and try and move forward with it. So moving on, the BSC basically focuses on factors that create a lot of long-term value that we need to understand. So here we'll be talking about traditional financial reports. Looking backwards, actually, traditional ones will always look into the financial sides, actually. So when we talk about traditional financial reports, we need to understand that it would reflect only the past. So where spending incurred and the revenue earned will be included here, and we will not be measuring or creating kind of like the destruction of the future economic value. We need to understand that. And the balance scorecard will generally identify the factors that will create the long-term economic value in an organization, kind of like, for example, if we take the customer focus, which will include satisfying or even retaining kind of like the acquired customers in target segments. And we will talk about the customer focus, and we'll also talk about like the business processes, where the value proposition to target customers will be developed here, and kind of like deliver the value proposition to target customer. Like here, it will consider things such as, let's say, innovative products and services. We'll also talk about high quality, flexible, and responsive kind of operating customer processes, actually. And it will also include things such as excellent post-sale support. So all these kind of business processes will be kind of included in the balance scorecard. So in one side, we'll be talking about the customer. In the other side, we'll be talking about the business processes. And also thereafter, the organizational learning and growth will be considered, where development skills of the motivated employees and access to strategic information and aligned information and team and the business unit objectives will be covered as well. So as I talked, the customer focus will be included here as well as the business processes. Then we'll be talking about the learning and the growth of an organization as well. So this is the balanced scorecard. As you can see, there are 4 main sections. One is the financial section where we'll be talking about the objective, the measures, the targets, and the initiative, where we try to succeed financially on how we can try to achieve our shareholders, what the shareholders want in an organization. And then we'll also be talking about the customers. As you can see, it is used to achieve the vision of the customers. And here, the objective, the measures, the targets, and initiatives will kind of be included here. Then the internal business processes will be actually involved here, where we'll be talking about the measures such as the objective measures, targets, and initiatives. Then the learning and growth to achieve the vision and how to sustain the ability to change and improve will be included with the objective measures, targets, and initiatives, as you know. So moving on, we'll be talking more about balanced scorecard, where why an organization needs to adopt a balanced scorecard. So we need to talk about change, where we need to formulate and communicate a new strategy for a competitive environment. And then we'll be talking about growth, where we need to actually talk about increasing the revenue, not just cut the cost. We will be also be talking about, hold on, sorry about that. So we'll be talking about formulating and communicating new strategy as well as growth, where we will be talking about increasing the revenue and enhancing productivity. And after that, it's about implementing from 10 to 10,000, where every employee needs to implement the new growth strategy in their day-to-day operation. Now, we'll be talking about 7 ingredients of the highly successful balanced scorecard program. So one of the things is the process to mobilize the organization and lead an ongoing change. Then comes the score that describes the strategy actually. So like link into scorecard to create an organization's alignment, then continuous communication to kind of empower the workforce, or even aligning the personal goals, the incentive, the competencies with the strategy will be very important in the balanced scorecard. And when also like aligning the resources, the budget and initiatives with the strategies, another section, one of the main ingredients in a balanced scorecard program. And also like a feedback process is included, which encourages the learning and experience of sharing. So this is what will be concerned in balanced scorecard. So another now, as you can see, it's kind of comprehensive, and it includes a lot of sections actually when it comes to balanced scorecard. But now we need to see, does all environment, are they all appropriate for a balanced scorecard? So balanced scorecard would generally drive from like the top, which will have a CEO or COO as a sponsor, like the CEO or executive leadership. Team commitment is very important. So a clear sense of purpose is kind of required, like to drive the change and to clarify to or even gain consensus about the strategy. Also to build a senior executive team, it is very important, and also to focus the organization to align programs and to invest. It's very important as well. Now, integrate, another thing that is very important would be to integrate cross-functionality. and to even educate and empower the organization. That is very important. And the dynamics of senior executive team with determining whether the balanced scorecard comes from a strategic management system will be very important as well. So now, now we'll be talking about the key pitfalls of so the key pitfalls that needs to be avoided in a balanced scorecard. So when it comes to process, the middle management task force not getting driven by the senior executive team is a pitfall action, because it's very important that the senior executive team is involved here, and also in the process not including only a few people involved is also a pitfall, because you need to have a lot of people involved in order to ensure that this is kind of managed properly. Too long a development process, as in, like, if the development process is too long, then obviously it would be very difficult to kind of monitor as well. And to delay introduction because of busy measurements is also a pitfall which needs to be avoided, and static, not dynamic process will be something that needs to be avoided as well. Also, treating the BSc as a EIS will also be a pitfall that needs to be avoided when it comes to the process. And if we are talking about the philosophy, the measurement to control and not to communicate need to be included, and management which dictates action versus employee improvisation to achieve desired outcome, or for management not only shared with employees need to be needs to be avoided as well. Now, moving on, we have two types of finance we are going to talk about: the short-term finance as well as long-term finance. So short-term finance, we were talking about sources of finance, right? So short-term finance is basically like the overdraft, or like different types of short-term loans. It could be like the trade credit or short-term operating finance related to bills, purchases, factoring and invoices, and it could even be non-funding sources as well. When it comes to long-term finance, it could be like equity finance, it could be debt finance, it could be the preference shares. We were talking and also be long-term finance, leases, or even the venture capital. So finance, the sources of finance can be short-term as well as long-term that we need to understand. So short-term finance, as I told, there could be overdraft, which is extended to credit facilities of a bank, and interest is generally kind of charged, and cost of overdraft will be calculated generally. If we look at the cost, it would be like the overdraft amount into interest rate. We take one minus tax rate because tax is deductible. And then like the short-term loans are like loans which are ideal way to overcome short-term financial deals, and then a short-term in nature, and the cost of the loans are generally allocated after removing tax effect. That is that. And then trade credit would be credit from suppliers, which can be considered one of the easier methods and cheaper sources of finance. And the main advantage is that it is not usually charged unless a default is made by the company. And there could be short-term operating lease, where the lease is a contractual obligation. However, it's for a small period of time, a short term. And the operating lease that functions as short-term finance is usually arranged within a 1 year and equates rent into an asset, or like, lease rentals, which are tax deductible. Bill purchasing or discounting bills which are payable within a period of less than 90 days are discounted here. And another way is factoring. This is basically outsourced of a credit control department to like a factoring company, and then the debts are effectively sold to like a factor which take the responsibility of collecting the debt for free. Also, like factoring companies generally provided kind of three services, which will have like the debt collection, the administration, and which could even be like financing and credit insurance. So the factor will generally advance up to kind of 80% of the value of the debt, and it would have like an interest rate which is more like 1.5 or so, 3, I guess, and charged on a daily basis. And invoice discounting is another short-term kind of discounting method, whereas in finance against security of the receivable without even looking at the outsources. Sales ledger administration to a factor is included, and it's also kind of like a part of the services that is provided by the factoring company, which are also specialized invoicing discounting companies as well. So one of the key advantages here is that it's confidential services and does not know about the money that is repayable when its debt is cleared, and also will be provided up to 80% of selected invoices, which are used as security against the funds which are borrowed and then the settled, and the company will pay the borrowed plus interest to the invoice discounted. Another method of short-term finance is, or source of finance, is the indirect or non-funding source, where the borrower does not receive any money through the funding method actually. So it's kind of like a letter of credit with one of the main sources, where the bank will issue a letter of credit, the LC, to its client, and the LC states the bank will make the payment to the supplier if the customer fails to make the payment. So LCs are normally used to import and export trade, and bank kind of impose fees to charge on the LC. Now we'll move towards the long-term finance or source of finance, which is one of the main thing is obviously the equity financing. This would represent the equity ownership of an organization, as you all know. So an organization would have like ordinary shares, which will give its right to its owner to have kind of like shares in the company's profits, as well as to vote at the general meeting of a company. It could like, it does not have like a predetermined dividend actually. So therefore there will be higher risk based for the owners of the ordinary shares. However, these they will be having a cost of equity which is higher, and this is not tax deductible like the other interest rates, and ordinary shares can be traded freely in a secondary market, and if the company is listed in a stock exchange, that is, and the price of the share will always be determined based on the market forces like the demand and supply of an organization, and it does not impact on the nominal value of the share. So one of the main things is that it could obviously increase in price because of the growth of a company. The cost of equity is generally used using dividend valuation model, where we can take the dividend declared today during the year, and we can increase it to the growth rate, and then divided by the cost of equity. Then we could also use the cost of equity using the CAPM model, where the return that is free of risk and the beta factor is kind of used. This there's no necessity for you to really know, because you'll be talking about and doing sums here about this in your investment appraisal section. And then we'll be talking about another source of finance, which is the debt financing, which is basically obtained through borrowing, in which organization has to pay a fixed interest, and interest is basically which is paid, or the organization are obliged to pay annually or on a set date. And these are basically tax deductible, and it kind of, if the company goes into liquidation, we need to understand The equity holders are the ones who will be getting everything after paying the debt. So the debt finance will have a less risk and obviously less cost of capital as well. And the ranking of repayment for the debt finance will be, would be higher than the equity holder. So there'll be different when we talk of sorts of finance. When it comes to debt finance, there'll be different types of debt finance, which could include the loan stock or debentures. It could be deep discount or zero coupon bonds, could be debts, banking finance, euro bonds, convertible bonds, and warrants. The different types of debt finances. These are all sources of finance, as you know. We are kind of trying to understand all the sources of finance and how things are managed in an organization. So I think that's all. I think I did a lot of things content today, but we went in kind of a quick pace because these are things that we actually know about. And I hope you did understand what I was explaining to you today. Hope to meet you with the next week with our 4th lesson, and I hope you have a nice day. Goodbye, everyone. See you next week.